Hello everyone, and welcome to your Glassnode video report for week 43. I'm your host Checkmate, and we're recording this on the 26th of October 2021. So congratulations to all Bitcoin holders. We've now broken to an all-time high of 66,900 this week. So a fairly impressive rally throughout all of October. And really a lot of this is being driven by the excitement, the hype, and also just the market mechanics behind the launch of the Futures ETF. So obviously it's going to bring more attention, more people, and more institutional access to this type of asset. So what we're going to look at is a little bit about the CME Futures, which is the underlying asset beneath the ETF, and just understand what's going on with open interest and the overall trading volume, just to really get a bit of a sense of things. We're going to look at our long-term holders and what type of spending behavior is going on. We touched on this last week, and we're really going to dive into a bit more detail. We're going to do a deep dive into the SOPR metric, which is a very, very powerful suite of metrics, and just understand how it works during bull, bear, and transitional cycles. And then we'll also look at some of the community Workbench charts, which we've recently rolled out, and just really explore what these look like, look at some of these new models that have come out, and just to provide a bit of a background on how you can actually deploy these. So let's jump into the analysis and get started. So as I mentioned in the intro, we've had a very, very strong October. We've broken up to a new all-time high. We passed April's all-time high, which is around 64,000. And we pushed up to just shy of, we got to 66.9. So an incredible rally throughout all of October, coming off this $40,000 low that we set back here in September. We can see that Ethereum is also painting a very, very strong chart. So what we're seeing is some fairly big excitement across the market, right? We're seeing people, the sentiment start to shift around. We're starting to see news headlines coming out, a little bit more positive light. And this is generally the reflective nature of this asset. Now, as I mentioned, a lot of this was driven by the hype and the excitement, but also the market dynamics behind this CME Futures-backed ETF product. Now, this product with a ticker symbol BITO, it's essentially launched and surpassed Gold's 18-year-long record of being the fastest ETF to get above $1 billion in total assets under management. And it achieved this within 2 days. So it shows that there is that level of demand. If we're looking at our open interest, so I've got two different sets of charts here. On the left-hand side is looking at open interest and futures volume for the entire market in orange. And then we have open interest just for the CME and futures volume just for the CME. So this is a regulated exchange. This is where a lot of the institutional volume in the United States is being traded. And just really to see how these two different metrics, right? We've got our total market and what's going on in these specifically with the CME futures. Now, what we can see is that on overall open interest, just note, we talked about this last week, there is somewhat of a risk when you have too much leverage in the system. And the question is, what classifies as too much leverage? It's not an easy answer to question. It really does depend on what's going on in the space. But what we can see is that we are trading somewhere around the all-time high in terms of total open interest. But also note that we were at this same level previously when we were at the all-time high at 64,000. Now, obviously, we had some sell side that followed that, so it's not without risk, but it does just show you that there's obviously more excitement, more people coming into the market. We can see that our volume is starting to uptick as well, which is always positive. And we can see that as we had our all-time high, where we had our maximum open interest, we actually didn't have the same corresponding volume. The volume actually followed the sell-off down from the all-time high. Whereas at the moment what we have is rising open interest and rising volume. So generally that's showing that there's more traders, there's more liquidity, and in any kind of flush out, when you have more volume, it just softens the blow a little bit. There's more trading volume to absorb any of that movement. So it's a healthier situation, but it is still something to just bear in mind as a potential risk that there is a lot of leverage in the market. And although we're going to assess in a second, but this doesn't tell you the direction of that leverage. Are everyone going long? Is everybody short? Or is it fairly balanced? We'll look at that momentarily. But what I do want to highlight is how explosive the growth in the CME is. We can see that this is more or less a relatively straight curve. This is going parabolic. So we can see that we've gone from about, so let's say 1.5 billion up to over 5 billion in open interest. I mean, this is a very, very dramatic rise in total open interest. And you can see how much of this has actually occurred over the last couple of weeks. And we can see it's actually maintaining that open interest, right? So there's even reports of the BITO ETF essentially hitting some of these CME futures limits. It's essentially starting to fill up those front month contracts. So overall, what we're seeing is that there is a huge amount of interest in this product, in this ETF product. It looks like it's generally more sustainable. We can see that the previous all-time high was kind of a fleeting event. And we also didn't have the same level of interest coming in from the institutional side and these regulated venues. note how we have a substantially higher flow coming into the CME in particular, which is driven by this ETF. And to really support this, we can see that the volume is almost up around $8 billion in a single day of trading. So, and this was when we set the all-time high. So there's a huge amount of interest flowing in. It's certainly a positive dynamic and how the ETF is going to play in. And it's something that we'll be paying attention to over the course of the next couple of weeks, just really looking at how the ETF changes market structure and the overall behavior of the space. So lastly, on the leverage side of things, so we spoke that there's some leverage in the system. It is elevated, but the question is it leaning in one particular direction? Because what you want to look for is the market all going long and everybody believes that it's going up forever? That's normally the time when people are not taking care of their risk, and it can create that downside risk. So what we generally look for is things like our funding rate. So whilst the funding rate applies to perpetual swap markets, these are essentially, they never expire futures contracts. And in order to have that futures contract that never expires, or the perpetual swap market, what they essentially do is they have this system where if everybody is leaning long and the price is trading higher, so the privilege of taking on leverage is pushing the price higher above spot, that will create an interest rate. So people who are going long to take on the privilege of being leveraged long have to pay an interest to the short sellers. And that creates an arbitrage opportunity that tries to keep the market generally aligned with spot price. So let's zoom into the last couple of months, and we can see that at the all-time high, as is generally tradition, lots of people were going very, very long at the top. Right? This is a very common pattern that we see. People get overly exuberant, we break to new all-time highs, the excitement is there, and too many people open up a leverage long. Now, since we've pulled back, note that a lot of this funding rate has actually declined. We've pulled back to what I would generally call a fairly happy or medium range, right? It's still positive. There are still people who are net long. The market is still pushing it net long. So there is still that bias to the long side. There is still that risk that we could get some of that leverage flush out. Perhaps it just means we're going to consolidate for a little bit longer. But note that it's also not continuing to rise as the price declines, because that would show that people are going even more long, even though the market is moving against them, which is generally a pretty bad sign. So what we're seeing is it's pulled back to a healthier level that's still net long. The risk exists, but overall, it's actually not looking as serious or as bad as it's been in previous instances. We can see when we were net long up here in May, there's a much higher funding rate for a more sustained period of time, even after some serious correction. So people were sticking long, even though the market was starting to signal we're actually heading the other direction, and that created a very significant flush out. At the moment, we don't quite have the same level of that leverage. And just to really close out on that point, what we have here is our percent futures open interest. So this is the number of open interest contracts that are backed by crypto margin. So if you think about this, you have to post some kind of collateral to take on leverage. Now, if you're posting a fiat stablecoin or fiat currency itself, then the value of that fiat currency is going to be stable. So it's not going to be moving around. If, on the other hand, you post a crypto collateral, say you post your Bitcoin up as collateral, when the price is moving, you've borrowed against that Bitcoin, and because the price of the thing you borrowed against is also moving, it compounds the risk. You've got volatility on top of volatility. So you're taking on leverage on top of an already volatile asset. So what this chart is showing is what percentage of the market is borrowing against volatile crypto collateral, which is these higher values, or as it declines lower, that means more and more people are using fiat or stable coins for their collateral, which is generally a more stable and healthy market. Now, note that in our previous all-time high back here in April, we were up here at 70%. So 70% of all futures were backed by some kind of volatile crypto asset. Note how this has been in a structural decline ever since. This is showing that the market is taking on a more risk averse, there's less leverage backed by crypto, more backed by stablecoins and fiat currency. So this is a very important observation. It's showing that overall the market is actually de-risking. So even though we have higher open interest that we saw here, in general, this is actually showing that the backing of that collateral is less volatile by quite some margin, only 45% now, relative to the 70% we had before. So whilst there is still open interest in the market, we have to also look at this in a broader spectrum and say, well, actually the collateral that backs it is less volatile. So even though the open interest is the same and the overall market is leaning net long, it's actually somewhat less risky. It doesn't mean that there's no risk, but it means that there is less risk on a relative basis. So that covers our the derivative side of things. This is kind of the new, with the ETF coming in, it's going to start to change these dynamics, and it's something that we'll pay attention to over the coming weeks and months. So when we trade up towards all-time highs, a very, very common pattern that we see is that long-term holders, or people who've essentially been in the market for a long time and they've accumulated cheaper coins, the probability of them starting to spend their coins increases. They want to take profits, they're taking some off the table, and some of them are actually getting dry powder in case we get a dip to actually reallocate. So what we're looking at is some of these long-term holders are beginning their spending, and we looked at this last week. Now, I've got a couple of metrics on the screen here just to really map out how significant this spending actually is. So we've got our total supply held by long-term holders, which we can see has been in a remarkable uptrend. This is several million coins that has continued to accumulate from down here at, this is 10.9 million, and we're up here at 13.3 million at the top. And you can see how significant this accumulation period really has been. So these are coins that were purchased, moved out into an investor's wallet, and are now aging into an older state. And generally, the longer that they're dormant, the more likely they are to stay there. Now, we saw a little bit of this spending. Last week, we looked at this very, very early sign. Let's actually zoom in just so we can really see the scale of it, which kind of is leaning to what I'm about to talk through. Note how small this actually is, and we're actually getting this reversion back to the upside. So this, to me, speaks to an event rather than a trend. Now, there's no reason this couldn't continue to trend lower, and we actually do see long-term holders really kick up their distribution. But this is around 39,500 coins, relative to over 3 million coins that were accumulated. So the scale of it is still very, very small. And note how we've actually reverted, continuing to climb back to the upside. It's actually almost at all-time highs again. So there has been some profit taking, but it's also not at the moment looking like a rush for the exit. So it's telling us that there is some strategic profits being taken, but it's not exactly the end of, like, we're not seeing people exiting the market. The conviction to hold remains, and that's actually telling us that most long-term holders are probably awaiting for higher prices. So it's telling us a little bit about that side. Now, our average coin dormancy and our binary coin days destroyed really confirm this. What we're looking at here is the average age of every coin spent per unit of BTC. It's ticking up slightly higher, but note it's actually not that much higher than where we were in 2020, which is kind of this pre-bull phase. Binary coin days destroyed shows us when more coin days are destroyed than average, and we can see we've seen a slight uptick on this as well. But again, what we're looking for, this is what fully sustained distribution looks like, a very, very long period of time. And note that price in a strong bull will rally into and absorb that sell side. So we have little sell side, a relative increase in dormancy and coin days destroyed, but note that the markets can sustain these uptrends for some time when it has strength. Now, obviously, if we see price weakness and we still see spending, that can change that assessment, but overall, this is generally looking relatively healthy. And we can see this just lastly on the long-term holders. We can see this gradual uptick in these warmer colors in our realized cap HODL waves. That's showing that we've had this reduction in young coins. This is accumulation behavior, which then was reflected in that long-term holder supply chart. We're starting to see a couple of those coins get spent from the older bands into the younger bands, but overall relatively small compared to what we've seen in the past. We can see that this can continue in an uptrend for some months and still have positive price as we see these coins get absorbed by the market. So it's telling us something about the demand side as well. So lastly on this, we're going to look at our SOPR metric. So SOPR stands for Spent Output Profit Ratio. And I'd certainly direct you to look at the Glassnode Academy entry. We have quite a few case studies on how we can use this metric. Now, what this is looking at, we can see on our axis here, we've got 1.3 down to 0.8. If we look at the entire market, which is what the adjusted SOPR is looking at, all of the coins spent that day, how profitable were they? If we take an average, how much profit or loss did they make? This is what this is telling us. So what we can see is that during bullish rallies, we get this uptrend, right? We get these uptrends, these swings higher. And it gets up around, let's just say 1.1, 1.2. That means that on average, traders are realizing gains of about 10%, 20%, right? And when it retraces back down to a value of 1, it's showing that overall the coins that were spent are at their break-even price. So there's not necessarily any profit or loss that's been realized over the whole market. So in a bull market, what we generally like to see is SOPR rally higher, which means that profits are realized, but the market is absorbing it, showing that there's enough demand to absorb the sell side. So uptrends are positive. However, when we get these extreme values, note here we got to 1.3. This is 30% profit on all the coins spent. quite a bit of volume needs to be absorbed, it puts in a local top. So we get these upswings, it establishes a local top, and then we get a pullback. Now in a bull market, what we want to see is this pullback and hit a value somewhere around 1. Sometimes we can get a little bit of an undercut, but we want to pull back to 1. Now, this means that the coins that are being spent are at break even, and that tells us two things. People who bought the top and are in a loss have stopped selling, because otherwise it would be trending far further down, which is what we saw back here in May to July. This was a lot of people capitulating and losing a lot of money and essentially selling all their coins at a loss. So when we see it retrace back down to 0 after a local top, it means that those loss-making coins have stopped selling. It also means that the profitable coins, people who bought back here, are also no longer spending. So it's actually showing that conviction returns to the market. And we can see a very similar pattern on our short-term holders, which is just more reflexive, but it pulls back down to 1, and then we get this bounce higher. So the SOPR provides us this indicator for when conviction returns to the market. No one's spending their profitable coins and no one's spending their loss-making coins. Now, during bear markets or periods of downside price action, we get these realized losses, and note that they're much more pronounced in the short-term holders. They're realizing much deeper losses because they purchased much more recently. Long-term holders may have purchased back here, and there's some of them that are offsetting the overall market SOPR. Now, where we are in the current environment is that we've broken out of this bearish phase. We've pulled back here in September. So note that in September, we pulled back to a value of 1 and we had a slight undercut. A couple of people sold their coins and realized a loss, but then we had a very strong bounce that followed that. And we saw this again on the short-term holder SOPR, and we've got a couple of these retests. Overall, this is showing that the market is absorbing sell side, it's absorbing profits, and it continues to rally higher, pulling back and resetting conviction. People are stepping in, buying the dip, and then the market is pushing higher. So overall, this is telling us a fairly constructive and positive story. If we were to break down below a value of 1 and stay there, that can then change that assessment, starts to look a little bit more bearish, but overall, this is actually looking relatively healthy. So now we're going to jump in and have a look at some of our community charts. So within Workbench, you'll note that we've actually included a number of these market indicators, various community charts, and other metrics that we've been building and deploying to Workbench. So these are presets that are established and ready to go. So we're going to go through 4 of these that have been developed by our community, and we're going to start with the top cap model, which was originally developed by Willy Woo himself. Now, what we have here is our market cap, and then we have in the blue is our average cap. So what this is taking is the lifetime average of all the prices through all of Bitcoin's history. So if you would take an average of every price of Bitcoin, then the overall market cap at the moment is sitting, you can see, some distance below. Now, what Willy Woo found is if you apply a factor of about 35 to that average cap, you essentially pick up a fairly strong top model, and it's picked up all 4 of the previous cycle tops. So what it's basically doing is it's looking at the average price of Bitcoin. It's then multiplying it by 35, which is, through empirical testing and trying to identify these particular multiples that give you the same result. And what we find is that it generally picks, with relatively high conviction, all of these tops. So the second model that we have uses a similar concept. This is by dilution proof. This is called the Bitcoin price temperature. Now, what this model looks at is Bitcoin normally operates in these 4-year cycles, somewhat around the halvings. It's also, we get the bull and the bear, so there's also an investment cycle involved. So between the halvings, the investment, and human sentiment, what dilution proof looked at is this blue line here, which is the 4-year moving average. Now, the 4-year moving average, you can see, generally picks up the very bottom of bear markets. It caught here in 2018, 2019. It caught us again here in March 2020 and in the 2015 bear. Now, what he's then mapped out is how far away is price away from that 4-year moving average. We assume that that's kind of the baseline or the floor price for that particular cycle. When we stretch too far away from that price, that starts to tell us when we're essentially oversold, overbought, or what is a fair value. So he's established this oscillator using statistical methods, standard deviations, and when we're looking at this green line, this is looking at 2 standard deviations away from the mean. So it's essentially showing us when we're at some kind of a fair price. You can see that it picked the 2019 top. It kind of traded slightly above our early phase bull, and then the late phase bull is trading above it. We pulled back and consolidated around this fair value line throughout the May through to October period. We can see that in the 2015, we traded far below it. During the early disbelief bull phase, we pulled up to the fair value line. And then during the late stage bull, we started to track into the 6 and the 8 standard deviation line. So it's got a topping model. In the blue, we have a bottoming model. And then we have a fair value, or kind of a middle price way to think about it, in the green line. Now, we also have the realized price to liveliness ratio, which was created by Dormancy. Now, what this model does is it looks at our realized price, which is in blue, and our price. Realized price is the market's aggregate cost basis. What is the price at which every single coin last moved on average? And in general, the realized price provides a bear market floor support. It's a ceiling during accumulation periods, and then rises rapidly when older coins are spent, being revalued from lower prices to higher prices and sold and changing hands. Now, we also have liveliness, which maps out when we have periods of strong hodling. This will trend down in the green when we have strong hodling going on, and trend much higher when we have lots of spending going on. So it's telling us what hodlers are doing on a general trend behavior. So what Dor did is he took the ratio between our realized price, which provides a very strong floor model, but you can see that price doesn't revisit it very often. It only really comes back at the end of bear markets. Now, when we take the ratio between realized price and liveliness, he's essentially correcting that model for when we have large hodling behavior. When lots of people are hodling, the fair value model, which is the realized price to liveliness ratio, will trade much higher. So you can see this orange line is kind of capturing when Bitcoin is undervalued. And we can see that it is more or less undervalued until the late stage of the bull. Most of the bear markets is spent underneath or between these two lines. We get a period of capitulation where it trades below realized price. The 2019 bubble was a little bit too soon, too fast, bounced above the fair value. We traded back below, traded back to the fair value. And note how during our recent market cycle, let's actually zoom in, we can see that we were actually caught right on the 29,000 level on this fair value model. So because we were seeing, even though realized price was much, much lower, we were seeing a lot of hodling behavior. So it's lifting the fair value. It's almost taking this cost basis and saying, well, here's our cost basis on a technical standpoint, but there's so much hodling going on. The fair value hodlers, the investors who have, long time horizons, actually believe that Bitcoin is worth more. So that is what this model is doing. It's essentially applying a multiple that when there's more hodling behavior, it will trade higher. The fair value, it's kind of like what the hodlers believe that Bitcoin is worth. And we can see that this has lifted up that floor and it really caught the lower phase of this bear. And the last model we're looking at was developed by Will Clement. And what this is looking at is the liquid or the illiquid supply. So what we classify the illiquid supply, which is this blue curve. We have this gradually increasing amount of coins that are what we call illiquid. They've been in a cold storage wallet. They haven't moved for many years. They're essentially flowing out of exchanges or out of liquid supply and moving into strong hand wallets. Now, generally speaking, this is continuously rising. Now, what we also have is our liquid and highly liquid supply. So these are coins that are either in exchanges, coins that have recently been withdrawn and they may actually get sent back in. They're coins that are not quite dormant yet. They're in that process. The highly liquid ones are essentially on exchange balances. They're constantly transacting. And we can see that this has generally been increasing as well, but over the course of 2020 has started to slow down and actually decline. So what Will decided to do was take the ratio between these. And the general trend of this is that when you have a downtrend, it's showing that more coins are coming into liquid circulation. It's showing that there's more coins circulating around and there's a higher probability that we actually need to absorb those. There's potentially going to be some kind of a bearish market trend. When we have an uptrend, on the other hand, it's showing that we're getting a reduction in liquid coins, but an increase in illiquid coins. More coins are going from a liquid state into an illiquid state. So let's zoom into our last couple of years, and we can see that our liquid supply shock ratio has continued to climb, showing that we've got more coins becoming illiquid and more coins coming out of liquid circulation. So overall, what it's looking at is this trend-based pattern of where is the supply moving. It will trend higher, which is generally more bullish. It's showing that coins are moving out of circulation, going into investor cold wallets, and starting to move dormant. And as we see more coins get spent back into circulation, we can see that this illiquid supply shock ratio will actually start to decline, which is what we saw here in May. Many more coins came back into circulation. The red line, or the liquid supply, increased. Our illiquid supply shock ratio decreased, and that's a generally bearish signal. So it's showing that more coins coming back into circulation. Buyers have to come in and absorb those coins, and it's generally showing a more bearish trend. So thanks to everybody who's watching these videos. I hope that you're finding value out of them. Certainly jump onto Workbench and have a look at some of these community charts. There's some great work that's coming in there, and we're constantly integrating new charts that are produced by our community. Give us a rate, review, subscribe, and a comment, and I look forward to seeing you next week. Cheers.